largest retail jewellery player, Senco Gold initial public offering opens for subscription on July 4th. 405 crore IPO comprises of fresh equity issue of around 270 odd crore and an offer for sale aggregating to the worth of around 135 crore. But to know more about the company's outlooks and financial, we're being joined by Suvankar Sen, MD and CEO, along with the CFO, Sanjay Banka, to Moneycontrol this afternoon, beg your pardon. I'm going to start off by asking you about straight up with your debt to equity ratio. That seems to be a little higher year after year. I wanted to understand why is the company not utilizing the cash on the balance sheet to pay off the debt, and also additionally, why none of the proceeds will be used towards the debt repayment?
Yeah. So no, I must say that now our balance sheet is very strong, and the debt equity ratio is around 1:1.1, and our debt is primarily working capital. So whatever we have borrowed, let's say around 1150 crore, that is primarily for the purpose of borrowing, and it is in line with the industry trend. And that's why we have been given A rate. In fact, we were rated as A minus for last 6 years, and this year, based upon our strong balance sheet, so our rating has been enhanced from A minus to A. So that is where we are. These are short-term working capital facilities. Now, your next question was why the company does not retire. See, any company which is hungry for growth, hungry for success, any smart business, it will borrow money from the banking system. It will deploy that money for generating superior return to the shareholders, and in the process, it will give the return to the banks also. So our blended rate of interest to the bankers is around 6%, whereas our return on net worth is 20%. So this itself gives an answer as to why we are leveraging the balance sheet for the business growth.
And adding to that, the large part of our debt is in the form of gold metal loan. So, gold metal loan is where you take gold from the bank in a lease way, and the price is unfixed. So it works for us for our hedging purposes also. And then that is a 180 days kind of a loan, which you have to fix the rate as per your sales and pay it off. So this is where, the large part of our loan is in the form of supply of raw materials. So that is how we would like to not reduce our debt, but, work on working with the same.
Sure. Okay, a little bit of aggressive strategy out there along with the fair share of fundamental that you've provided. But let's talk about the working capital days as compared to that of the industry standards. What are the key reasons for a higher number of working capital days, and what are the steps that are being taken to mitigate it, or rather just lessen that? Because working capital days are to an extent of around 160 versus the industry standard to an around 140, if I'm not wrong. So how would you look at it, and what's your outlook on this one?
So basically, if you look at working capital days or inventory days, we are number 2 in India.
Okay.
Number 2.
In terms
So
of the listed,
in terms of inventory days, that is around 160, and the inventory turnover is 2.5. And so basically, because a person comes for buying 2 or 2.5 times jewelry buyer, so we believe that we are best managed. But yes, there is always a scope for improvement, and we will work on improving through our ERP, through movement of the stock from one store to other. But as of now, we believe that our working capital days is among the best, and that's why when the rating is done in the credit rating, this factor is considered, and we have recently been upgraded from A minus to A.
And also, ma'am, the working capital is an outcome of the business model that we have. Now, our business model currently, as on 31st March 2023, we have 136 stores, out of which 75 are company-owned, company-operated, and 61 are franchisees. Now, in this franchisee business, the franchisees are buying the stock outright, and it is this blended model that is allowing us for a shuffling of stocks as per the demand of the customer. We are shifting the stock, selling the stock from store to store or to the franchisee. So this fast agile movement on fulfilling of the demand of the customer will help on reducing the working capital number of days. So we are all working on fulfilling customer demand, and automatically we will hope to have a better working capital cycle.
Sure. I'm just putting in comparison of the company along with the listed peers in this segment. There's a lot of competition around, and within the RHP, I was reading that there is a company's revenue CAGR, if I'm supposed to look at the number for FY21 to 23, as compared to something like Kalyan Jewellers, or for that matter, Titan Company. Now, the company has clocked a revenue CAGR of around 23.8% during this period, versus Kalyan Jewellers to an extent of 29%, Titan of 37%. So, what explains this revenue CAGR, which is slower as compared to the other peers?
No, see, everyone is working very hard in order to grow their business, and we have full respect and understanding, and we all learn from each other. Now, our business model has company-owned stores and franchisees, and in certain cases, we have seen that our company-owned stores in the bigger metro cities have had a higher growth rate. But sometimes we have a large number of stores which is in the tier 2, 3, 4 cities of the country, and there sometimes because of the high gold prices that have happened in the last 6 to 8 months, the consumers have not been able to increase their sales, and the growth has not happened in the smaller towns. So we will continue to work on the growth. If you look at the CAGR growth over the last 3-4 years, see, we have had a consistent growth. In the first wave of pandemic, from 2019-20 to 2021, we grew by 10%. After the second wave of pandemic, we grew by 35%, and then the next year we grew by 15%. So our growth has been consistent and steady and sustainable, and that is how we would like to look at it. And this IPO proceeds will help us in terms of utilizing it for working capital and furthering our endeavor to grow more with the help of that same. So this is how we are looking at it.
Sure. So you raised the point where you said that the growth is essentially coming from tier 2, tier 3 cities. Is it possible that you're now probably looking to expand in more geographies, because 80 to 85%, or let's just put it 72 to 75% comes from the north and east, So how do you intend to, if at all, do you intend to diversify geographies, or you intend to stay concentrated in the regions where you're operating?
So just like, a DMart strategy, we would like to focus the way we have done it in the past, east and northern part of the country. We leveraging on the economies of scale, on the brand, on the goodwill, on the the marketing expenditures that we do to reach out to customers. So we will intend to continue a same ratio on focusing more on east and north part of the country. And the focus that we have done in the tier 2, 3, 4 cities, I must tell you that we are I would say that currently many jewelry companies are there, but for our franchisee model that has helped us to penetrate into the smaller towns has been a model which has been existing for more than 15 years, almost 20 years. And we can say that currently, after the leading jewelry company in the country, we are one of the few jewelry companies that have sustainably and consistently played on the model and run it successfully for so many years. So this is how we would like to utilize the experience, the knowledge, and the capability of expanding for the future as well.
Sure. If I'm just supposed to take a step back and look into the financials from a very aerial perspective, and just look at the cash flows for the last 2 to 3 years, 2 financial years, just from the operations segment, right? FY22, we saw a negative, cash flow of 31 crore. In FY23, the number dwindled, but still was around 17 odd crore. How are you looking at it? And, how can, the people who are interested in the IPO probably look at the financials at this point of time?
I think that's a very interesting question. See, it's an optical illusion. See, this is based upon the accounting disclosure. Let me put it differently. Basically, let's say we had a PAT of last year 130 crore plus 20 crore of, let's say, depreciation 150 crore. That's a free cash flow to us. And that free cash flow has been deployed for the purpose of new store and expansion of existing store. So there is clearly the business is free cash flow profitable. And similarly, in the current year, when our PAT is 160 crore and plus a 30 crore of 190 crore, less dividend paid around 9 crore, that entire is a free cash flow available to us. There is a accounting disclosure which has to be adopted in line with the industry, where the GML, the gold metal loan, which have been disclosed as a operating as a financial activity, the moment that is moved up to operating activity, that optical gap which is there will be closed, and you will see a positive cash flow. So what we want to reiterate that the business is profitable and it's a cash flow profitable. Our free cash flow is primarily used for expansion and new stores, and that's why optically it looks as negative.
Sure. Let's also talk about the segment-wise breakup where there is a lower diamond segment sales mix in the portfolio. What steps, if at all, the company is taking to increase that pie from this segment in the overall basket of revenues that you have?
Right. No, very well pointed out, ma'am. 85% of our business is gold jewelry, around 10-11% is diamond jewelry, and 3% odd is the platinum, silver, and other kind of products. So, but if you look at the other way around, then the margins that we are making is with already 85% gold jewelry and 10-11% diamond jewelry. The profits, the margin that we are making. Also, if you look at the year-on-year growth, in the last 2-3 years, we have been growing on double digits, almost 25-30%. Last year also, our diamond jewelry sales went up by 35%. So in the last 5 years, it's almost doubled. So that is how we are looking at it. With the increase in gold price, we firmly believe that our selling of diamond jewelry, which is made in 14 karat gold or 18 karat gold, will go up, and we are taking the necessary steps in terms of design development. We already have Everlight as a collection and a brand that is focusing on daily wear, casual wear, everyday wear, jewelry up to rupees 1 lakh of rupees in diamond, platinum, and gold. So we are taking all the necessary steps, building on the brand, the design collection, so that we can push our diamond jewelry sales. And it is happening also historically. We are motivating our team and training them to do the same as well.
Sure, gentlemen, I also want to understand from you if you guys can explain a little bit about the hedging policy on the jewelry, and also the fact that why does the company charge differential pricing across the market when some of the players have introduced uniform price across the country?
So hedging,
Yeah,
you take, I will take.
Yeah, hedging I will take. So hedging, basically in the first place, we have a well laid out hedging policy in place, which says that hedging, the major inventory should be majoritarily hedged, and we want to reassure you and give you comfort that our hedging gives us adequate and proper hedging, which means that due to any increase in any fall in the gold price, there is no material impact on the P&L account. Similarly, in case of any increase in the gold price, we will not benefit. So basically, we are agnostic to the gold price increase, and we don't take any view on the gold price. And as of March 23, we were hedged to an extent that it was at a very high level, and we'll continue to do that. So in the last year also, there was while the gold prices increased in Q3 and Q4, whatever was the gain on account of that, it was neutralized by the lower side on the hedging policy. So hedging we do, to give straight answer to you, we do by way of a gold metal loan unfixing, which means that we don't fix the price of the gold for 180 days, and we fix it based upon the sales made and continuously keep it open. Secondly, we do the hedging on the MCX also. So the blend of MCX level hedging and gold metal loan hedging with the bank, it keeps our balance sheet totally de-risked.
So
Right.
I wanted to understand, just a follow up there. When you say hedging FY23, what is the amount of hedging, the percent there? FY24, how much do you expect to grow that by? And also, since we are hedged, there is a little less sensitivity towards the gold prices. So the windfall gains that otherwise the metal could see doesn't percolate down into the financials. So what kind of sensitivity ratio can we see at gold prices versus profit?
Madam, we won't be able to give you the exact percentages. All we can tell you and assure you is that we are majoritarily hedged, and the risks hedging is done to mitigate the risk of price volatility and ensure that if there is any possibility of losses, that is minimized and mitigated. So we are taking all the necessary steps and strategies through our treasury team, our hedging committee, and we are reporting it to the management. So we are doing all the same. We won't be able to, unfortunately, give you all the details in terms of percentages, but we can assure you that we are majoritarily hedged. And as far as your question on the the gold price strategy that we are doing, every brand has their strategy, and everyone is right to their own. Everyone is following a particular thought process. We believe that based on the local market, because ultimately It is the organized segment and the unorganized segment, and the acquisition of customers from the organized to the unorganized. Now, how will you do that? You can do that through superior product and designing. You can do it through superior price services, or through a very aggressive pricing. We believe in design. We believe in sustainability. We believe in long-term growth, and therefore, based on the market condition, much like another brand who is there and playing a leadership role, we believe that as per the market condition and demand, we should follow our pricing. India is a country of multiple states, multiple culture. Every state is unique to their own. The demand is different. Somewhere the studded ratio is high, somewhere the studded ratio is low. So therefore, the market standards of the local market should be maintained. This is how we are moving forward.
All right. I'm just a little, still stuck up with the fact that sure you could not give in percentages the hedging ratio, the number, but could you give us some sense of sensitivity relation of gold prices vis-a-vis your profits?
Let me give it to you.
Like a 1% gain in gold price can lead to how much of profit, if at all, given the hedging portion is higher. So I just wanted to understand that a little more in detail.
So let me put it differently. Last year, the gold price increased in quarter 3 and quarter 4. Ideally, my gross margin should have increased. But if you look at the RHP, it increased only from 15.7% to 16%, 0.3%. So which clearly indicates that if I was not following a proper hedging policy, my gross margin should have increased by 1 to 1.5%. That is answer one. Second answer is that last year there was no material impact on account of hedging. No major profit went into hedging into P&L account on account of gold price increase. If the price increases, we lose on account of hedging and we gain on the inventory. And if the price falls, we lose on the inventory and the sales made and gain on that. And even last year, so even in March 22, the impact was not material. Right. That's what we can say.
And we do our hedging basically through the flexible gold metal loans.
Yes.
Or we have future sales on the exchange, or we are doing sell call or buy put as and the option. So these are the 3 to 4 methods we are using for hedging our.
How different is the industry standard as compared to your policy on hedging? Do you follow what is the industry?
As per the industry standard.
It is exactly same in line with the industry practice, and we have been following the earning call of other listed players as well. And we believe that we are following the best practices.
Sure. Let's now graduate to making charges. I wanted to understand more about it. Is that charged as a percentage of your sales value or fixed? And how do margins therefore move with respect to the gold price?
Yes, so making charges range between 8 to 9% to up to 18 to 20%, and it is a percentage of the gold value. So this is how it is charged across the various markets. So if the gold prices go up, the absolute amount of the making charges will go up, though the percentage terms of the making charge shall remain the same. And if the gold prices go down, then unless we increase the making charges, the absolute amount of the making charges will go down and the percentage remains the same. So this is how the making charges are charged.
All right, Mr. Sen and Mr. Banka, we're just going to leave it at that. Thank you so much for taking out the time and speaking to us. Wish you all the luck for the IPO and hope, like all the IPOs, this also sees much of the success. Otherwise, that the market appetite has been, you will be able to capitalize hopefully for that. But with this, we're just going to end. And thank you so much for taking out the time. Well, with this is the last.
Thank you. And we all want to thank you for the opportunity. Our brand is more than 50-year-old and we have been consistently growing. You'll be happy to know when I joined in 2007-8, we were only 134 crores. Today, last financial year, we crossed 4,000 crores. So it's a 30x growth. Growth is in our DNA. And with all the system processes, audit, the best of auditors of Grant Thornton or KPMG, the ERP of Microsoft that we have, the trust we have created, more than 20 lakhs of customer base we have. Every year our average ticket size is 60 to 70,000. So it's very much jewelry that the upper middle class of the country can buy, aspire, the various collection and designs we have. I'm quite confident that we can, the way we are making our customers happy, we would like to really, really make our investors happy also.
All right, so fingers crossed on that. And let's see how the IPO fares. But Viewers, with this, it's a wrap. Thank you so much for tuning.
Thank you, ma'am.
Thank you. Thank you.